My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'd be one to make friends. I'm just trying to make you some money. Because my job's not just to entertain, but to educate and teach. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Out with the old. In with the old. We have a tendency in this business to make decisions by calendar, especially the changing of the guard in the new year. Ladies and gentlemen, it doesn't work. It doesn't work for one very simple reason. Other than the change in the calendar, nothing's changed in the economy. It's still slowing. Nothing's changed with the Fed. It's still focused on raising rates to bring down wages. Nothing's changed with earnings. What's bad stayed bad, and in some cases, the bad was accentuated. Yeah, it got worse. So we got a stupid sucker rally this morning. I mean, unbelievable. It's based on Europe. It quickly fell apart by the time we did our daily 10:20 a.m. broadcast, exclusive for the Investing Club, with the Dow ultimately shedding 11 points, S&P slipping 0.4%, NASDAQ losing 0.76%. Believe me, it was much worse earlier in the day. It was so bad that I just said, is it going to be another 2022? Now, look, I've been off for a week and a half. Thank you. So let me remind you what was working and what wasn't going to be working into the holidays. Because, again, despite what you may hear about how the new year brings big changes, it just doesn't. First, because we're going into a slowdown, the recession-proof stocks tried mightily to stay higher. Think healthcare or consumer packaged goods. They were working. We bought a health insurer for the charitable trust today. I feel good about it, as the group just got hit with some very wrong-headed downgrades. I don't think they'll make money on those sales at all. Second, the China non-zero COVID stocks continue to work their way higher because now that they're reopening, millions have caught the virus, but there's no going back. At this point, China's headed for the fabled herd immunity, although they're getting it the wrong way by letting everybody get sick, rather than the right way by giving them the best vaccines. Herd immunity not great for the elderly. But Wall Street only cares that China's back in business. The best performing stocks today were China-related stocks. The worst performers were, once again, the oils. Crude just can't seem to find any footing. As long as West Texas Intermediate, though, is above 70, I think this should, the oils will have good yields. The ones that have good yields should come out ahead. I'm betting it stays above $70 because there's less supply from Russia and more demand from a reopened China, although we don't know how much yet. We just told club members to stay the course, but it won't be easy if crude tumbles to the high 60s, down roughly $7 from here. Why stick my neck out for the oils? Because these are companies with cheap stocks that throw off tremendous amounts of cash flow. Eventually, they will matter. That'll matter to the market. Not yet. Sometimes you got to go against the proverbial grain, betting it can change. Hey, by the way, later in the show, I'm going to make that a compelling case for buying the stocks of crude here. Meanwhile, the semiconductor stocks continue their race to the bottom. They are just awful. I mean, it's incredible, isn't it? All of them opened up huge, the perfect pick-off, and that led to some real bad trading and only some kick-outs, as this group can't be trusted. We had a semiconductor glut last year, and I don't see that ending anytime soon. It's not necessary. It's not necessarily getting worse, okay? It's not. But you're jumping the gun if you think it's getting better. Finally, let's address the elephant in the room. Spend some time here on the mega cap tech stocks. They were down last year, and they're going down again today. Before a late-day rally allowed some to finish higher. Out with the old, in with some of the old. For the longest time, we valued these stocks like their high growth rates could continue forever. Money managers will pay a massive premium for the stocks with endless growth. Last year, we found out that's not the case. They got too big, too cyclical, subject to the same booms and busts as every other company. Now their stocks are crashing back to earth, and that's helped, by the way, of course, with the Fed bent on crushing high inflationary growth. Now, we've been telling club members that if you don't already own Apple, you must wait until you see the whites of Apple's eyes, which in this case could be a brutal pre-announcement. It'll be interpreted by the negativists as an Apple glut, too much product. Still, I believe Apple issues are related to supply, not demand. It's going to be a tough time to own stock, But Apple's such a high-quality company. I mean, come on. I'm sticking with it with my usual attitude, own it, don't trade it. Now, sure, hey, listen, maybe you can sell it. Get out right here. Good for you. But can you get back in at a lower price before things turn around? I don't have that confidence. The rest of the megas are, they're really, well, they're trouble. Tesla just reported a shortfall in fourth quarter deliveries, sending the stock down another 12% today. It doesn't help that Elon Musk has been forced to sell so many of his shares in order to prop up Twitter. This is the worst possible time for him to be distracted because it's the year the major automakers can finally sell high-quality electric vehicles at scale. Tesla's never had any real competition before. Amazon and Apple both have a chance to go on higher, but it might not be easy. Amazon's fate's in its own hands. They just have to say, all right, you know what? Forget what we've been doing. Let's do this. We're going for profitability first and growth second. That's the opposite of their whole ethos. But it's what Wall Street wants to hear. I think CEO Andy Jassy might need to fire up to 200,000 people. And let's shut down, hey, I don't know, 10 annoying ventures to get the stock moving again? Brutal, but that's what the market demands. Alphabet's interesting because it sells for 17 times earnings. That's just like an average stock, for heaven's sake, because it turns out to be an advertising company. The good news is that Alphabet now has an excuse to shutter costly side businesses and lay off many of the people who aren't accomplishing all that much, including the ones that are all trying to teach that they hired just this year. The only kind of, just last year. The only kind of advertising that goes up in price is the NFL. They now have it on YouTube. If it turns out you're running an ad company, hey, why not have the best must-watch programming to advertise against as opposed to what they had? We thought new media was different from old media. Apparently, that's not the case. But all Alphabet has to do is run itself like an old media company at this point to get the stock going again. Yeah, I'm not kidding. Like the old CBS. Microsoft is such a quandary. Can you imagine hiding in a stock that sells at 25 times earnings? But CEO Satya Nadella knows how to deliver. You know what? He's the anti-Elon Musk in every single way. Finally, there's the debacle that is Meta Platforms. Yeah, I'll just do this because everybody wants me to do it. Here's a stock that now trades at the same price-to-earnings multiple as a solid tool and die company. When your shares are that cheap, you got a lot of leeway to do a lot of things, even wrong things, and still see the stock go up. That's Meta, soon to be known as Reels, their TikTok knockoff, as the anti-China sentiment may spell the end of TikTok in the United States. I can't tell you how important this could be for the stock. Mark Zuckerberg is trying to commercialize something that can't be commercialized right now. Right now, meaning for the next couple of years. The metaverse. As nobody wants to stick a headset on and walk around looking like an avatar made by a fifth grader, okay? I mean, am I near it? Am I going to walk into a wall? Someone help me. That's what the metaverse means right now. It's not the ultimate shopping mall. It's the ultimate hit-a-wall. Where you can, the mall would be good. I mean, you could try on clothes, go to the aisle, maybe do some banking. Amazon on steroids. Maybe one day it will be. But for now, Zuckerberg needs to put someone else in charge, slash the budget to ribbons, get the free cash flow growth to positive. It's been very negative. And fund an aggressive effort for Reels to take massive share for TikTok. Amazing. He is not even behind the attack on TikTok. Remember the old Facebook would have shuttle and they'd be getting money to people and stuff to get it so that we'd realize that TikTok was just Mal's latest venture? No, now they're Mr. Clean. If Meta can do that, then the stock can make a comeback. But it's way too soon to make that bet. Look, we have a lot of a lot to talk about as the week unfolds. We're going over the winners and losers in 2022. That could be the best performers 2023 for the next few days. But bottom line, if you have one takeaway from turning the page on the calendar, it's the meaninglessness of the stock market calendar. It always will be. December, it turns out, I learned this when I was in second grade, is really close to January. February is not between December. Well, you know the order. The fundamentals are what matters. And sadly, we have not turned the page on the economy, just the calendar. Hey, do you mind if we go to Jeff in Florida, please? Jeff.
Happy New Year, Jim.
Happy New Year, Jeff.
Hey, I'm a club member and a longtime fan of you and the show. I'm also a Berkshire Hathaway Class B holder. Would this be a good time to add to my Berk B position?
Yes, I would buy more Berkshire Hathaway. I mean, look, it's got, I've got to tell you, this stock may be really the right level. And I know so many people worried about what's going to happen after, I don't have to talk about it. All I can tell you is this. It's a very inexpensive stock, and I like it. Some people would say it's actually a cheaper way to play Apple, and it's been a winner in the last 3 months. Right, now, we are turning the page in the calendar, but you have to remember that it's actually meaningless to stock market, and don't let people tell you otherwise. You're going to say, oh, January bodes well for this. No! The fundamentals are what matters. We haven't turned the page on the economy. We made money tonight. The mighty Dow had some big winners in 2022. I'm digging into the 5 names that I think could keep cruising higher in the new year. Then this market remains hostage to the Fed's fight against inflation and commodity prices. They're a huge part of it. So I got to go off the charts on a handful of key commodities to see where we stand as I have the hiccup. Can you believe it? First day of the year. Stand at the start of a new trade year. And could the worst performing Dow stocks of 2022 present some opportunity this year? I'm giving you 5 more big ideas for the next year. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.